Hi folks, in today's video I am going to be going back over some of the managed investing accounts that I've been trying out. Over the last few months I have been trying out various different platforms and having a look at what their managed offerings look like. So if you're the kind of person that knows they want to invest but you're not really sure what it is you want to invest in, then managed accounts might just be the thing for you. So stay tuned. In this video I'm going to look at 4 of the most popular platforms here in the UK and further abroad to see which one has made the most money in that short space of time. And the results might be kind of surprising. Stay tuned. So if you have been following along on my investing updates the past couple of months, you'll know that the 4 platforms I'm looking at here are InvestEngine, Nutmeg, Moneyfarm, and I've been using Lightyear as a kind of baseline for which to compare all these managed accounts with. So these managed accounts are going to offer all different kinds of products for you to invest in. When you take on a managed account, they're going to ask you a series of questions to get your idea on risk, to get your feelings on how long you want to invest for, what you would do if the stock market drops or rallies all of a sudden, things like this. And they try to put together this sort of profile, this risk profile suited to you, and then they serve you up some kind of offering like a ready-made portfolio for you to go and invest your money in if that's what you want to do. So when I was signing up for these managed accounts, I tried to answer the questions in a similar way as I possibly could in order to try and pitch similar products against each other. And as we go through these different platforms, you're going to see that what they've come up with is actually quite different in parts. And of course, being ever so slightly different, it's going to have produced different returns. So let's not waste any further time. Let's just get straight into it on the accounts. Moneyfarm's first up. So I've got 700 quid of my own money invested in this since I think around about October time, and we've made £47.98. That is inclusive of fees and everything else right up to this point in time when I've recorded this video. So that's not a bad return. That's pretty good. So we can see a little sort of graph as we go along. Time marches on. Upward goes our graph. 100% of my investment is in this managed general investing account. So have we look at that? There's various different prices Moneyfarm have been offering. The one I'm going for here and what this portfolio is for is fixed allocation, and the management fees start at 0.45%. That's quite pricey. I have a video on compound interest and how that can really work for you. The fees work in the same way. Those fees are compounding every year. So if you're thinking about investing long term, 0.45 is touching the expensive side, because you'll also have the cost of the ETFs that make up that portfolio as well on top of that. So bear that in mind, but all the same, £47.98 is a pretty good return for a short space of time. Let's have a look at that portfolio. So you'll remember me saying at the top of this video that I tried to answer all the questions the same to try to get the most aggressive portfolios going. I thought that would lead to the most interesting fluctuations. And you can see the most aggressive portfolio that was on offer, certainly at the time I did it, means we have 83% in stocks, equities, 10% in bonds, and 5.5% or so in others, things like commodities and real estate, which I thought that was quite interesting until I realized that there's actually no real estate in there. So that is a pretty aggressive portfolio, high risk, high reward. That's the idea. Equities would certainly be more volatile than bonds, so it is pretty heavily weighted towards equities. In terms of sectors, we've got IT, government, financials, others, consumer staples, consumer discretionary make up the top holdings in this particular portfolio, and the spread across the world as you would expect. A lot of it is in the United States. Emerging markets, United Kingdom make up the vast bulk of this portfolio. So there you are, Moneyfarm, quite aggressive. That's what I asked for, and the returns have been pretty good. What's not to love? So that's Moneyfarm. Before we move on to Nutmeg, I just want to let you know that this video is not sponsored by any of the companies mentioned in this video. There are, however, some affiliate links down in the description, and if you're interested in checking those out, you might be able to score yourself an extra bonus if you're signing up to use any of these platforms. Let's get on with it. Alright, next up is Nutmeg, and you can see for the £700 here, we have returned £61, which is a simple return of 8.78%, and I like it that they offer the time weighted return here as well, 9.61. That's pretty good for such a short space of time. Again, I'm going to attribute most of this to the fact that we are investing aggressively, and the stock market has been going pretty well of late. So certainly on the face of it, that looks like it's performing better than Moneyfarm, but let's have a wee quick look and see why that might be. Please bear in mind that I set this up specifically to try out these different services. So when I say Nutmeg Provider Challenge and I took a fully managed risk 10 out of 10, my risk is not necessarily the same as yours, so please go in with your eyes open. If you're investing, you may get back less than you put in. Bear that in mind. This was for an experiment, 10 out of 10 for risk. Let's see what's in there. So as mentioned, in the summary page here, you get to see that returns after fees is going to be £61.43. That's pretty good. Let's have a look and see how that's divvied out. So where Moneyfarm was adding some allocation to bonds and to some commodities, you can see that Nutmeg have gone entirely for stocks, more or less. There's 0.4% here left for cash, but developed market equities, emerging market equities, and global equities are making up the vast majority, 99.6% of that. The lion's share goes to the United States again, United Kingdom, Japan, France. The sectors are again heavy towards information technology, financial, industrials, same sort of thing as what Moneyfarm are doing, but with everything being in equities, I think that's why we've seen a higher return for this short space of time. Microsoft, Apple, Nvidia, everyone loves Nvidia at the minute, don't they? Shell, AstraZeneca, Amazon, all those big players are all the big holdings in this particular portfolio of mine, so that's pretty good. Let me just go back to the dashboard because I want to bring your attention to Nutmeg's fees. They are not cheap. So my net contribution is £700, investment returns for all time 61.43, and the fees are 1.79%. So that is a 0.75% fee. That is quite expensive, I think. Now there's cheaper managed options out there. Moneyfarm are one at 0.45. The next one we're going to look at, InvestEngine, is cheaper still, and we'll get onto that in just a second. The underlying fund cost as well is 0.22%, and the average effective market spread is 0.04. So they're starting to rack up there. We're close to 1% for management fees. I don't love it. I don't love that kind of fee, but fees are part and parcel of good business. It keeps the business sustainable, and if you're getting value for your fees, then there's no issue. It's whenever you start to pay for things that you don't really need, that's when it starts to get a bit iffy, and this, personally, for me, would be too much. But for this experiment, it's good to see what's going on. Nutmeg, fees included, are still in front at this point in time. It's going to be interesting to see how our next platform, InvestEngine, stacks up against that. So what do you think of those so far? I'd love to hear your thoughts in the comments below. What platform are you using and what kind of things are you investing in? Do managed accounts appeal to you at all for the upcoming ISA season? I'd love to hear all about it down below. Alright, let's go to the next one. Alright, InvestEngine. So the screen goes dark for dark mode. InvestEngine is my ISA platform for the last 2 years. I use the self-managed option with the platform for my main ISA, but of course for this challenge we are looking at managed portfolios. So let's just scroll down here, i.e. provider challenge. Oh, £76.09. We have a new leader. Fantastic. Very good. Okay. So we've made 11.46% here, £76.09 on our £700 investment. So again, it was full aggressive mode here. I went for their riskiest profile that they could put together for me. InvestEngine are another one that are going to build your portfolio up by ETFs. So collections of ETFs, and smash them all together and give you this one portfolio that is going to represent all your investments. As you can see, they've gone 96.2 equities, 1.8% bonds, 1.9% cash. Xtrackers, S&P500 is a big player here, emerging markets, and then we keep going down into other ETFs here. But again, the S&P 500 being the big player here, is where all the big tech companies are, where all the big companies are listed in America, largely speaking, shooting up in the same way that we've seen with the other platforms. In terms of fees, every ETF has its own fee. And for a managed account, InvestEngine only added 0.25%. I think that's pretty affordable. If you wanted to take on a self-managed ISA or an investment program with InvestEngine, it is entirely free, with the exception of the ETFs, which you pay for on any platform. That's just the way it is. But there will be no charge at all from InvestEngine for their self-managed stuff. 0.25%. To have somebody put together an investing portfolio, to look after it for you, to rebalance all those things that you would expect to get from a managed portfolio, is pretty good. It's part of the reason why I have my stocks and shares ISA with InvestEngine the past couple of years. It's because they're really interested in long-term investing. They're keeping fees really low for investors like you and me, normal people who just want to get their money working for them. And I love that about them. I'm actually pretty pleased to see them come out on top between these 3 managed accounts. So that's 3 managed accounts out of the way. I only have one left to look at, and it's not really a managed account. I was using Lightyear just to buy S&P 500 and topping it up with money market funds to see just how a plain old index tracker would do against these managed accounts. Here it comes. Got my Lightyear app up here, and we'll have a quick look down, and we'll see from a £700 invested, I'm sitting at £786.55p. That is a massive result for just such a short space of time, which would lead you to conclude that investing in the S&P 500 and forgetting about all these managed accounts are the way forward. A couple of things before we get into that a little bit more. Lightyear only lets you buy whole shares of the ETFs that it offers. So at the moment, that's £76.26 for the S&P 500. So when I didn't have enough for a full share, I've been topping it up with some money market funds. I have another video on money market funds. If you want to check that out, I'll leave a link somewhere about here and you can go and find out about all what those are. But on those, I have actually made around about 59p there on interest, as well as what has been returned in the stock market. It's very easy to look at results like this and decide that it would be just better to invest in the S&P 500 the whole time. Personally speaking, I think the S&P 500 is just a bit too narrow. I like a global index tracker that takes into account more about what's going on around the world in different places, and there's certainly ETFs that would be thematic. Things like clean energy, or things like video games, or something like AI is a popular one these days, things like that might pique your interest for short-term investments. For me, I'm all about long-term investments, and a global tracker would certainly sit better with me than just the S&P 500. So that's all the results. At the end of the day, 3 or 4 months is a pretty short time frame, and the stock market has been on something of a rally recently. Everything seems to be going up, which makes it a little bit difficult to compare. Some platforms will inevitably be more conservative than others, and a managed account isn't trying to do anything too exciting, nothing too spicy that's going to cause a lot of volatility, which is why it's easy to see something like the S&P 500 is outstripping these managed accounts. When the stock market is doing well, generally the S&P 500 is doing well, and those big cap stocks are, moving forwards very rapidly at the moment. But in times of reversals, these managed accounts are likely not to see such drastic pullbacks because your money's more spread out across a more diverse range of products. It's horses for courses. At the end of the day, what you decide to invest in is entirely up to you. So by my reckoning, that leaves Moneyfarm in last place, probably because they dared diversify a little bit. Nutmeg sitting in third. Probably those high fees are going to hurt them long term. InvestEngine sitting in second place. Low fees, pretty flexible platform, but right at the top of the pile, the S&P 500. Running away with it. Thanks for watching. I'll see you in the next one. If you are interested in more content like this, don't forget to subscribe, leave your comments below, and if you want to see what I'm investing in, then check out this next video here.